All right, here we are. It's a Tuesday morning. The market is about to open, and I just wanted to talk to you about. Well, first of all, I wanted to apologize yesterday. I know I kind of billed it as okay, we're going to come on and do live trading, and I didn't do that much trading. But the thing is that this is an authentic. This is real. It's a real position that we're really trading here, and sometimes I just didn't want to do much with the position. So I got on here. I was like, okay, we're going to do some live trading. But then I'm like, I don't really want to make an adjustment right at this moment. So I'm not just going to, trade just for just for YouTube viewers or something like that. It's a serious position. And if there's nothing to do, there was nothing to do. So sorry for that kind of anticlimactic video. So I have two ideas moving forward with the position here. We kind of had that spike and then it's come down a little bit from here. But now that we're back from the one extreme or another, I want to consider something called the Bullseye Position, which is kind of something I've sort of been developing by studying some of what Tom Snyder, a guy on YouTube, on StockTwits, has been talking about, as well as others. And this is the idea of trying to be short front week at the money calls in UVXY as a means of making money. And, the at the money calls in UVXY each week are decaying the most. And so if you consider a call kind of like stock in a way, if you've got a call that starts $2 over the price of stock and ends the week at the price of stock and I'm using stock as a term for the ETP here. If you've got a call that's at the money and it's trading like $2 in premium. So for example, UVXY is 31. This call is trading. The 31 call is trading $2, then you've got and you just sit there for a week, then it's almost as if you sold UVXY at 33, and then at the end of the week, it went down to 31, and you scalped $2 shorting the stock. But you didn't really short the stock, you just sold the call. But if every week you can sell a call that is the equivalent of shorting a stock, having it go down $2 and buying it back, then that's a really great thing, because so if, for example, if UVXY goes from 35 to 30 over the course of 5 weeks, but each week you sell a call for $2 and that call goes from $2 to 0, then instead of a $5 move in the stock, you've actually got for each dollar it moves down, you're selling a call that's worth $2. So instead of actually capturing a $5 down move in the stock, you're actually capturing a $10 down move in the stock, because for each dollar UVXY moves down, you're selling a call that actually collapses by an extra $1. So that's kind of the strategy about selling naked calls. And the one of the beauties of this strategy is just that it's simple. It doesn't have as much risk as some other things, and you're not using as much commissions as some other things. So essentially, the idea is for every $5,000 in equity in your account, you sell one at-the-money naked call, okay? And so the rules of the game here are, if UVXY, at that expiration day, so you'd sell a call on a Monday, expiration day, and the bell is going to ring here in a couple minutes, so disregard that. You sell a call on a Monday, and at the money call. On expiration day, if the call is out of the money, you let it expire worthless. If it is in the money, you roll that call out to the same call next week. So you buy that short call back in the front week, and you sell a similar call, the same strike call, in the next week out. And in this manner, you keep the position going. The beauty of it is there's less risk and less volatility than putting on spreads or trying to time things, and you just keep it mechanical. So I was thinking with our sample position, we would try doing this. What about when UVXY goes from 30 to 35 in one day? Well, in that case, what you're going to do is you're going to do nothing, because you're just, let's say that you sold the at-the-money call, the 30 call. So UVXY goes to 35 in one day. So you're short the 30 call. You've got a paper loss on your sheets. You wait until the Friday of expiration. If Friday of expiration, let's say UVXY is still 35. Well, you're going to roll your short 30 call out to the next week short 30 call. And although this 30 call is not at the money, isn't going to decay as fast as an at the money call, it's still going to decay. A $5 in the money call is still going to decay. There's still some premium. As long as if you look over to the 30 put and the 30 put is worth anything, then there's still some premium in that 30 call. And you can figure out what parity is in the call as well. But and you hang out until until UVXY does close on expiration below 30. And you just hang out. If weeks might go by, it might get up to 37, it might get up to 40. You just keep rolling that 30 call out. When it does, and the reason this position works is because we know over time UVXY is going to go lower. So in normal times, let's say 3 times out of 4, that at the money call you sell, there goes the bell. I understand if you guys have to leave. That 30 call is going to go out worthless. However, the times when you get a spike or something, it's just as if you were short the stock. You're just going to hang out and you're going to roll that call forward. But the whole beauty of it is that you're getting an average kicker, not only of contango going in your favor, beta drift going in your favor, but the premium decay is going in your favor too. So that combination of things is very powerful. And believe me, it feels much more comfortable being short one call when this goes up than having a big put spread on that's got this big delta attached to it. And this is a scalable situation. If you've got, $50,000 to play with, then, maybe you sell 5 or 10 calls. But what I propose we do is we test this out and we try it. So let's, when do you decide not to roll? I would say if you're committed to this position, you just keep rolling. But I would suggest we try this out and see how it works a few weeks in. So right now I did sell an August 31 call yesterday in UVXY. If you look at the position here, I sold the August 31 call at $1.70, $1.78. It appears to be working right now, but we'll kind of have to wait and see. The other idea I had with this is to look forward in time to, let's say, October, and say, what is my best guess of where UVXY will be at October expiration? So if I were to take a general guess right now of where UVXY would be at October expiration, I would say $23, right? So what can I do? I can buy a time spread, right? So I buy, if we say, okay, my reasonable guess for UVXY October expiration is 24, so we can go ahead and buy the October 24 call, and we can sell the either the front week or the next week out call. And in this case, we're so far away from strike that it's not going to be worth doing this, because look, if you look over at the put is pretty much worthless. So you're not getting any premium in that call. So that would be too deep of a call to sell on a calendar. So let's consider this a position that we're not going to keep on till expiration, but we just want to peg. So let's pick another call, October 27 call. So if we were to buy the October 27 call and sell the 30 August 27 call, now you've got 90 cents premium in the put there. So if we were to buy the spread 10 times, it would cost $2,000. Let's say we buy the spread 20 times and model it here. So we're basically saying we feel this is going to move lower in the next few weeks. We're picking the 27 strike. If we were to buy this calendar spread, the 18 Oct 30 August calendar call spread 20 times, it would cost us about $5,000, $4,500. And look at our Greeks here. We're short a delta, which we have a short delta, which is one of our goals with UVXY here. We're collecting $60 a day, and we just kind of manage our position from here. I like this idea of we're collecting money and we're short a delta. I mean, the Greeks here look really nice. They actually look nicer than being short a naked call. And we could practice this one. Yeah, but what if there's another 9/11 or 2008? You'll be bankrupt. Well, I mean, we can thanks, Ed, for that question. We can model where our risk is, right? Okay, so if we're selling one naked call, okay. And yeah, there certainly is risk. There's no doubt about it. If we sell one naked call, basically you can consider that as if you were short 100 shares. So this goes up. So if we go to our Analyze tab, right, we can model this. So short one of the 31 calls. So if UVXY goes up 50%, okay, we would lose $1,400. All right, if UVXY goes up 100%, and actually to see where you would go bankrupt in Thinkorswim, there's an easy way to do that. You go to BP effect here and you click on it, and it's going to show you. It shows you here this PNR number. UVXY, if you're short one naked call and you have this account has $5,300 in it. If you're short one naked call, this account would go bankrupt if UVXY went up 176%. So that means if UVXY went to, so 100% would be, what, $60? If this went up what was it, like 80, if it went up to 80 or 90, it would wipe out this $5,000. However, that means it has to gap up 176% to wipe out the $5,000 account, right? If it goes up a little bit and then you cover, then you haven't wiped out the account. If this were to open $90, right, I would lose all $5,000 on the account being short. Being short one call. And yeah, that's a risk, certainly. To make $176 a week off your $5,000, you incur some risk. It's the same thing if you opened a store and you're selling something and you put up $5,000 capital, and you could have a storefront, you're selling something, it's costing $5,000 in capital to run the business, to make $175 or $200 a week, and the highway could come by and say, we're putting an exit here, you have to move, or some natural disaster could happen to you. There certainly is risk, but what we need to do is we need to quantify the risk, figure out what our risk is, and say, are we comfortable with that? Now, for me, I'm comfortable with saying that, okay, if UVXY goes to 90 tomorrow, my account of $5,000 is going to be wiped out. I'm willing to take that risk to collect this kind of money. You may not be. The other thing is if you do feel completely uncomfortable with naked calls, you can protect yourself against that risk by, for example, what if you were to say, all right, I'm willing to take that risk for the first 2 days of the week, and then once it gets to be Wednesday or Thursday, I'm going to go up here and I'm going to buy one of these out of the money calls. I'm going to buy one of the, the 59 call for 3 cents. And that is going to cut my risk off at $60. So, this goes up 100% and I'm out. So there's no way, for the first 2 days of the week, if this gaps up 200%, my account wipes out. But from then on, I pay $3, and I protected that very unlikely risk by paying $3 for the next 4 days of the week. So there's ways that you can, the beauty of options is that you can take whatever risk that you feel comfortable with or that you want to. For me, I feel comfortable selling a naked call, knowing the risk is that I'm okay up to 178% move in UVXY. I've had risks on before where if a stock moves 40%, I mean, BYND, I had a risk on where, BYND was up 60% in one day. It was going to wipe out my account. And I felt comfortable with that when BYND was trading $200 because I felt like at that lofty price of $230 or something, it wasn't going to gap up another 40%, but it certainly could have happened. And yes, you certainly could lose a lot of money if the extreme thing happens. But, that's the game we're playing here. We're playing a game of risk. And the reason why people are paying us is to take their risk off of their hands. And that's the game we're playing. It's an insurance game. So we're going to be successful. And then there's going to become a time when it's going to be a reckoning. And hopefully we can just sidestep that reckoning. The Vomageddon I was able to sidestep. But yes, there's risk involved here, certainly. And that's something we can talk about. That's something you can get comfortable with. And we can manage. That's the whole name of the game. So, to summarize the position right now, basically I took off the short put spread and I'm considering my options here. Which is, and what I've done is I've sold one naked at the money call yesterday. I sold the August 31 call at $1.78. It was looking a little bit better a few minutes ago without this up 64 cents, but I'm still up by, the market's 160 bid at 163. I sold it for $1.78. So we're just hanging out. And so my idea was to monitor the position, and it doesn't sound very exciting being short one naked call. However, if we can get a system that's mechanical, that works, and that makes money every week, it doesn't sound like a lot of money, $178 for a week. But if we scale this and we're selling 10 calls, then it's $1,780 a week. And if we can produce that every week, and we have a system that we want to have a system that when the worst thing happens, we can manage it. That's what we're focused on, the worst thing happening all the time. Normal weeks, collect money, whatever. What we want to be focused on is the worst thing happening. So I like that idea of, as these farther out of the money calls get cheaper and cheaper during the week, you have a bid in. If you can buy the 50 call for 2 cents, for $2, you've collected, if you sell one of these at the money calls for $2 Monday, you can sacrifice 2 or 3 of those cents to protect yourself from blowing out by buying like the 50 call for 3 cents later in the week. Today's only Tuesday, and look, the 50 call right now could be had for 5 cents. So you're selling one call for 200 cents, and you pay 5 cents to protect yourself against the worst thing happening. So that's an idea if you feel less comfortable with your position. But this thing that I call the bullseye is to just sell a naked option that's at the money and always have that one short naked option that's at the money in UVXY, so that as it slowly moves lower, not only are you moving lower with it, if you're short the stock, it goes down $1, you're making $1. If you're short a $2 call each week and it goes down $1, then you can make $2 instead of $1 each time. So twice as much money on each buck it moves down because you're playing the game of being short something that's the fastest decaying option on the board. And you're positioning yourself so that every week you are short the fastest decaying option on the board. And so it's a beautiful thing. A lot of people have been successful trading UVXY this way, but let's try it ourselves. So do you stop yourself out because won't the strategy not work if you don't continuously sell the same strike? Yeah, that's a good point. If you sell this 31 strike and it goes against you, then when you roll it, you need to roll it to that 31 strike, even if it's in the money, and you've got to just keep rolling to that 31 strike until it comes back down. Now, if you had, for example, sold the 25 strike a couple weeks ago, this spiked, and so you'd still be rolling that 25 strike until it comes back down to that strike. And that's the way we would play it. All right, so I hope this wasn't too confusing for people. Tell me your ideas on this stuff. what you think about it. What do you think? This is what I would like to know from people. Do you think when you look at this chart, now I'm not a huge chart guy, but when you look at this chart, it really does look like it's an important section on this chart. You see how this is like top here, top here, top here, and it can't seem to get through this 2940 level. Is that very important? Is it obvious that we should have sold the market right here because it hasn't been able to make it through this level once, twice, and now it's a third time it's bouncing off this level? And if we do break through to like 2960, does that mean we're definitely going higher? It seems like a very important level here to me. And once again, I'm not a huge chart guy, but I noticed this level here. Are we going to go back down from here? We'll have to wait and see. All right, well, thanks for checking in. I'll let you guys get back to the trading day because it's just starting, and we will go from there. Thanks for watching. See you next time.